Saturday morning to you, and welcome to On the Mark. Alongside Mark Papa, I'm Gary Byron. Mark Papa is the president and CEO of Financial Resources Group out of Glastonbury, Connecticut. You can find him online at www.frplan.com. That's F as in Frank, frplan.com. And the phone number, because I do want you to call him. He's got, I tell you, I don't know many people doing this. He's got something of value to you. I know you're going to love this. In fact, I'll tell you how much value it is. $2,500 of value for you for absolutely nothing. Just be one of the first 5 callers to respond today. 860-657-8380. I'll say that again. 860-657-8380. And if you missed any of those points of contact, no worries. I'll repeat them at least a couple of more times before the show is over. Mark, good morning. Great to see you.
Hey, good morning, Gary. Good to be here. How are you?
Doing well. How was your Memorial Day weekend?
It was nice? Great. It turned out I ended up had a surprise trip to Newport, and it was raining, but it was still fun. Made the best of it, and then Monday the sun came out here. I was able to do some grilling, like I said last show. So I was excited to be able to go to my favorite market and buy my favorite things and grill them up, and it's got the tail end of the holiday.
How's your little guy doing? Did you spend some time with him over the weekend?
Yeah, he was with me on Monday, so
that's awesome.
Yeah, I spend a lot of time with him, so it's great.
You're a lucky guy here. I want you to do 2 things before we get into the thick of the show. Can you, number one, do the disclaimer? Because sometimes we get on a tangent and then we're backed up against the wall at the end of the show with 30 seconds to go. The second thing I'd like you to do is, I did this as a teaser a moment ago. You have something of some significance. It's substantial in its value and what you're offering for $2,500. I want you to get into that in a second.
Gary, the value of what we do with the 21-point checklist, if I were to be paid hourly to do it, is about $2,500 an hour. But what people need to understand is the true value far exceeds that $2,500.
True. Yeah.
So it could be a turnover cost that we find is $6,000, $7,000, $8,000 that their advisor never showed them. And we ask, why did your advisor not show that to you? And they're like, well, it just cares about making money. Or there'll be other areas like hidden fees, unnecessary taxes, that'll be passed on to the clients, that the advisors are just not trained in tax and not allowed to give tax advice. They're not mindful of it. I mean, the CPAs that I work with know it, but people just sort of accept their fate. And hey, I don't want to be greedy. I'm making money, but your people are leaving a lot on the table. So $2,500 is a true pittance compared to the average fee that we find per $250,000 is $3,291 in benefits they're owed or unavailable or not aware of. That's on per $250,000. So if you take that on $1 million account, which a lot of people have, that's 4x that amount every year. So you're talking $12,000 to $13,000 in value every year, and in 10 years that's $130,000, and in 20 years it's obviously $260,000 in lost benefits. So and that's without compounding. So Gary, I mean it's a no-brainer for people to come in and sit down with me for a couple hours and get this stuff done and scrub through all those little things that can jump out of the weeds and bite them.
Yeah, I mean, the way you put it, this is really a win-win for them, because it's not going to, the value of that, it's not going to cost them anything. All right, really quick, your disclaimer, and then we can move along here.
Very good. The opinions expressed during this program are those of Mark Papa personally and do not necessarily reflect the views or positions of Financial Resources Group, LLC, a registered investment advisor. State registered. All investments involve risk, including the possibility of loss of principal. Nothing discussed on this program constitutes an offer to buy or sell any security or investment product. Past performance is not indicative of future results. Financial Resources Group, LLC is a registered investment advisor in the state of Connecticut. Always consult with a qualified financial professional before making investment decisions. And I also have some other news, Gary. We are probably in the process now of prepping to register with the SEC, so we'll be an SEC registered advisor.
Really?
Yeah, we've had a lot of growth over the last quarter or so. I'd say the last 6-7 months. They've had a lot of growth due to both onboarding new people, but also our portfolio performance. It's been tremendous. So
That's federal then, right?
yeah, that's more of a federal. That's SEC.
And you would have a different disclaimer with federal.
Probably, yeah. But I would seek legal guidance for that, sure, for sure.
Can you announce when that will be?
Oh, we're in a fast. We're snowballing now. We're on a full court press to get it done because we're butting up against it's $100 million, and we're butting up against it, and we're getting too close for comfort. So I'm already talking to vendors and security updates, and I mean we're doing all the stuff we're supposed to be doing to get ready for that. So
congratulations.
That'll be my summer, aside from meeting with clients and doing annual reviews.
Well, folks, what does that tell you? Right? That in and of itself. Congratulations, Mark. Folks, we've got a big show for you today. One that I think every Connecticut investor, every saver, every person with a 401k needs to hear. We're going to cover two stories that are on the surface look very different, but actually they are deeply connected. The first is a question about history. Are investors comparing today's market to the wrong decade? And then the second is really the most talked about investment event in years. The coming SpaceX IPO. And Mark Papa, I know with Financial Resources Group, is really kind of an important part of the conversation. Mark, how would you answer those two questions?
Well, the first thing I'd like to mention is that we discovered the opportunity to get into a fund that owned SpaceX, and at the time was an $800 billion valuation. Shortly after they acquired Grok, that put them at about $1.2 trillion, roughly, and now they're looking at $1.75 trillion potential listing price. So we were able to get our clients in, and at the time, it was like 14% of the fund. Now it's a significantly greater percentage of the fund. Same fund also, if you saw that IPO, Cerebras came public. So this was not something that we put in our model portfolio, but it's a product that we were able to offer clients as a one-off, the people who had extra money lying around, the people who had a bit of a risk appetite. But SpaceX is definitely probably is going to be a historic IPO, and there's a lot of pros and cons to investing in it. So I want to talk to people about that because it's all the rage right now.
All right, so let's start with the macro picture because there's been a lot of talk about how today's market resembles the late 90s, the dot-com era. A few dominant tech stocks, retail investors piling in, AI just driving this. Really, it's a euphoric sentiment. So you're saying that comparison is wrong. So where should we actually be looking?
All right. So my good friend, anyway, on full disclosure, we own 3 of their ETFs in our model portfolio. They're tremendous people. John Davi, who's the CEO of Astoria Advisors in New York City, put out a really interesting piece. And this looks, the inflation, if you do a comparison to where inflation is today to the 70s, this market looks more like the 1970s because the 1990s inflation was benign. It didn't have the same impact as it does today. In the late 90s, early 2000s, there was really not a lot of inflation at all. Now we have, unfortunately, pretty significant inflation. So, the 1990s comparison makes a surface level sense. And there's a handful of stocks leading the market. The valuations are expanding. The retail enthusiasm is back, and the market, it's like, nothing can even slow this down. I mean, the belief that technology can solve every economic problem is what everyone's, basically talking about, that AI will create the efficiencies and lower inflation. And I agree with some of that point, but defining the characteristics in the 1970s, we've been for a very long time now that inflation was going to be higher for longer. And we've done that since we invested in an ETF called PPI, and that was one of Astoria's very first ETF launches. We were very early in that product, and we wanted to hedge against inflation. We saw it coming post-COVID, and we did not exit or get fooled by the Fed saying, hey, Fed's going to cut rates 3 times. We didn't get fooled by that head fake at all. In fact, thanks to people like John and some of the people on our team, including myself and all the reading we do, we said, no, inflation is going to probably stay higher for much longer, and it's very, very sticky.
Yeah, and Warsh just got, since the last time you and I were together last weekend, Warsh got sworn in, and I think Trump was expecting maybe a cut in the rate. I don't see a cut. I see, if anything, I see he could actually add 0.25%. I'm just digressing here. Walk people through the inflation picture, because a lot of people feel like, well, we got through the worst of it 2 years ago. Is that necessarily true?
Well, unfortunately, it's not true. Inflation expectations have now climbed to their highest level in 4 years. CPI and PPI, the Consumer Price Index, the PPI, which is the Producer Price Index, have both started to accelerate again. So sticky services inflation and the recent rise in producer prices suggested we may not get a smooth glide back to the Fed's 2% target that everyone has been counting on. Apollo has also done chart work overlaying Apollo Investments' current inflation trends against the 1970s analog, Gary. And the pattern is striking. It is really scary to see, but it's almost identical. And in the 70s, people thought inflation was under control after the first spike, and then it came back much harder. That second wave was devastating for portfolios, and we're prepared for that.
And what does that mean for interest rates and equities?
Well, let me just give a quote. After initial inflation spikes subsided, many investors believed the problem had been solved like it did in the 70s, only to watch inflation surge again. So if you take a look, Gary, the 10-year Treasury has now had surpassed 4.5%, when historically it had been a difficult level for equity. So what happens if interest rates rise above the level of, I can get 10-year Treasury risk-free or buy a stock, okay, because the difference between the risk I'm going to get and the return I'm going to get, risk reward versus the stock versus the bond, becomes less and less, and that could have a potential harmful impact on not only equities but also future equity returns.
Wow! So if the 1970s is the better analog, what was actually working in that environment, and really, what does that tell us about today?
Well, back then we had Fed, 1997, 1998. We had Fed rate cuts. You have a tailwind of falling rates. Today you have a headwind of structurally elevated rates, and that changes everything about portfolio construction. And then also have to mention that the Strait of Hormuz. I just read yesterday that the U.S. production is not going to be big enough to fill the gap left by the ships not being able to pass through the Strait of Hormuz. So we could see a pretty high spike in oil prices as well. I think that's going to happen. I'm not a betting man, but it looks pretty clear about what's going to continue, and we can have a massive oil shortage in the short run. It takes time to get those rigs up again. It takes time to, empty those ships. It takes time to absorb. So you have to get those. You have to get that oil delivered, and so we could have a big lag, which I think could spike oil prices, which is not good for the market.
Mark, I want to use everything that you just laid out as a backdrop, okay, for the second story that we're covering today, because this week I was reading in Barron's. They published a piece that is getting a lot of attention. The headline: SpaceX IPO is a game you should play at your own risk. That was the quote of the headline. SpaceX is expected to go public in June, potentially at close to $2 trillion valuation, the largest IPO in U.S. history. And I want to ask you, if investors are already using the wrong historical lens for the whole market, are they using the wrong lens for SpaceX too?
Well, that could get very interesting, and I think, Gary, that is exactly the right question to ask. The excitement period around SpaceX in the late 1990s mentality in its purest form, it sounds very similar. That most of the technology, finding the most exciting technology company, you buy it at any price, and trust the future will justify it. And that playbook worked in the 90s because you had falling rates, low inflation, and a long runway of multiple expansion. In the 70s style environments where rates stayed elevated and inflation stayed structurally higher, that equation changes dramatically, but also realize that you could buy an IPO back then when a company's market cap was $100 million. Now they're not going public till, 10, 20, $30 billion in market cap. They're staying private for longer. So that means, the clubby, investors who are venture capitalists, the high net worth folks, the people with risk appetite are able to get into those companies at a much earlier level. They stay private for longer, and they get these exponential returns, and then they go public. So SpaceX is essentially going public towards the top of the market of its valuation. And now what some could criticize or say, is that, okay, you're going to buy it at a $2 trillion when it goes public. If you buy it the day of the IPO, God knows if it's going to spike or fall. Now you have to see, in order to get a return on your money, hope that it goes to 3 trillion, 4 trillion, and 5 trillion, and that the business model is strong enough to support that. So I want to keep it at a high level. I don't want to get too granular on this, but the people who bought it at a $100 billion valuation, and some of the best investors in the market and kept putting money in, are going to cash out. Right? They're going to be able to make a very large profit after the lockup period. So that's going to be. So those are the folks who are going to really benefit the most.
So let's get into the numbers a little bit, because Barron's had a great line. Buying into this IPO is not getting in on the ground floor. It's actually parachuting onto the roof. All right, so what does this all mean in practice there then?
Well, basically, Gary, it means the era of getting in early on a great company is long gone for public investors with SpaceX. Okay. Again, we were able to get in at an $800 billion valuation. That was like January, February timeframe. So that's great because the fund that we work with owns it. They own it at a much lower valuation, but we still got in at $800 billion. And if it goes to 1.2 trillion, that's not a bad rate of return for that portion of the portfolio of the fund. So we're happy with that. But I would much rather get it at $100 billion or much earlier. But it means that era is gone. The company was worth $30.5 billion as recently as 2018. Today, it's expected to come public at $1.8 trillion to $2 trillion. That's roughly 60-fold increase that private investors have captured. 60-fold. Damn. So when you buy at the IPO price, you're not getting it at a discount. You're buying it at a price that lets private investors cash out, basically. Facebook, now Meta, still holds the record for the most highly valued U.S. IPO. At the time of its IPO, it was $81 billion in 2012. SpaceX could become public at more than 20 times that size. If you just put that in perspective for a minute.
All right, so what does the historical record actually show about the largest IPOs?
Well, I mean, if you take a look, the SpaceX, Meta, or was Facebook at the time, came public, and then, kind of just like anything, they come public, they have a great debut, then they have to do their first couple quarterly earnings calls. They have to show that, they're able to meet their targets as a public company. How are they going to behave? How's management going to behave? So it takes time for these companies to go from private to public, and I think there could be some hiccups along the way. So I wouldn't. My advice to anybody is don't chase this IPO. If you were in the private fund that we bought, fine, but you don't want to be chasing this thing as a day trader. Or you don't want to be chasing the valuation at all. You want to I would probably wait and let things settle in before you took a position in it.
Does Elon Musk become the world's first trillionaire?
I think that's a very, very possibility. Very good possibility that's the...
By the end of this year?
I don't know. I don't want to predict that, but I think it's very, very possible. I'm not a guy I'd bet against.
Folks, no, me neither. You are listening to On the Mark alongside Mark Papa. I'm Gary Byron. Mark, of course, president and CEO of Financial Resources Group out of Glastonbury. You can find him online at frplan.com and at this number, 860-657-8380. I will repeat that more towards the end of the show. All right, and then there's a specific data cut about companies with very high, I think it's a price to sales ratio, which SpaceX actually would certainly qualify for, right?
Yeah, that is the statistic coming out, and I keep coming back to since 1980, Gary, companies that came public at least $100 million in trailing revenue at a price to sales above 40, I've seen an average 3-year drop of 45% from their first day's close. So there's no guarantee. There's people who are going to try and flip out of the IPO, whatever, or try and trade it that day. But SpaceX would come to market at 93 times trailing sales at the extreme end of that data set. Now, it's an amazing company, hard to duplicate, hard to replicate, and it has an amazing business model, and it's a very long-term play. But remember, we're talking about a backdrop of higher interest rates, sticky inflation, and that adds an additional pressure on high multiple stocks, given that the 1970s analog makes the risk even more acute at this point. You have to be aware of that. And I don't think there's a lot of people talking about, the 1970s type of inflation print right now. It's not making lots of headlines. So the fact that I want to share that with everybody in the radio today, that we're more like the 70s than the 90s, that it makes buying these IPOs a little bit more of a cautionary tale.
So, all right, let's talk about the lockup question, because Barron spends a lot of time on that, waterfall of stock that eventually hits the market.
Yeah, and there was just an article that I guess there was some news saying that they were actually going to let some of the people exit prior to the IPO and get some liquidity. But there is going to be, there is some structural risk here, and everyone needs to understand is that typically private shareholders can't sell for 6 months after an IPO. SpaceX is engineered as a stage stock, so some of the shares freeing up after the second and third quarter earnings reports. So you're tied in there for a while. Another batch tied into stock price targets. So Barron's quotes a secondary market analyst who says that this represents a massive waterfall of stock, so more unlocked volume that has ever hit the market at any one time. And there's also a broader force amplifying this. NASDAQ just introduced its first entry rule that lets mega cap stocks join the NASDAQ 100 in as little as 15 trading days. And the S&P 500 has proposed shortening its wait time to 6 months. So index funds will be forced to buy SpaceX, and that creates temporary demand, which is exactly what private investors want and need to use for their exits. So that's actually a positive. So that should support the stock.
Yeah, but
I mean, it's so huge it could distort the entire market. Is the point?
Well, the business itself is genuinely extraordinary. You're talking recycled rockets, Starlink serving over, I think it's like 10 million subscribers. You have an $11.4 billion in revenue at 63% margins. Orbital AI data center concept. I mean, my goodness, how do you make the case for patience to someone who truly believes in this company?
Well, I mean, as far as I'm concerned, if you look at the best investors out there, I'm clearly not going to be selling my shares of the fund that owns SpaceX. I won't be selling them. I'm not going to recommend clients sell them. So, I'm going to stay there for the long haul because this is a really interesting, very unique business model, Gary. But, it isn't an easy conversation because the business is extraordinary, but Barron's also captures that the investor psychology. And a UBS private wealth advisor they spoke with also said he's never seen so many inbound inquiries on an IPO in his entire career. So, I mean, people are excited about this. And most of those calls aren't about the fundamentals. They're about the fear of missing out, what they call FOMO, fear of missing out. And, I should have, I wish I, noticed this years ago. But, you always look in the rearview mirror. But, hey, at the very least, we're in there. We're in there, and then we're in there well below what the market is going to be involved in. And this is something I caught on to. I found a company I knew and trusted, and I started calling our clients about it.
All right, let's bring this all together for people because, all right, so we had look at the 1970s inflation analog, right? The mega IPO wave, if you will, the rate environment, if you think about it. If you're sitting down with a Connecticut family right now, what's the practical advice for them?
Well, first things first is clearly you don't want to build your portfolio exclusively for a 1999 speculative boom. Right. Diversification has been a big winner for us. It was a big winner last year. We were able to beat the S&P. I won't say how much. It wasn't, but we beat it. And then this year we are trending ahead of the S&P as well because we saw the higher for longer inflation. We saw the cyclical trade away from the Magnificent Seven earlier in the year. We saw energy, we saw gold and silver. So we have a little bit of everything in the portfolio to help augment those risks. But certainly, I would say that still most of the people I meet are highly, highly concentrated in the Magnificent Seven stocks and basically very highly pegged to technology. So that's something that I would recommend people. Hey, although technology is doing very well right now, the data center build out is helping our gross domestic product. It's a huge percentage of that increase, but you really want to help diversify away from just the Magnificent Seven because you might see, your statement looks great one month when the market's hot, but the downside could be murderous. And just going back to 1999, the Nasdaq, in the 99-2000 after April, it took a couple years, but it lost 75% of its value. So you have to look through the trees and understand, and it's time be diversified, protect your money, and not if you want to take investment risks, that's fine, but let's make sure you have money that's tucked away that's also safe.
All right, and quickly, the through line here, the thing that connects the 1970s inflation research and the SpaceX IPO, is that investors, they keep reaching for the exciting narrative at the expense of what? The boring fundamentals, right?
Yeah, and what happened with us, Gary, is the boring won earlier in the year. The boring trade was great. The boring trade did very well for us. So there's really nothing wrong with having some boring in your account, because what happens is those companies eventually become so undervalued that there's no choice but to buy them. And what happens, the institutions are smart. They're going to take money off the table, reduce their positions, and then they're going to look for things that are cheap in the market and maybe long-term investors, very similar to a Warren Buffett style. So part of the portfolio has a Warren Buffett style to it. The other part of it has a growth aspect to it. Another part of it has a quality company factor to it. So this is why we like the factors, is what we're able to do is we're able to mix it up just right, so that we don't have just one dominant theme, but also we have a diversified portfolio. We don't have too much concentration in any one company or any one sector or any one theme for that matter.
Mark, as we wrap this show up for this morning, why should someone call you right now?
Well, I mean, Gary, I think the main reason to call me is the managing the money. What I'm seeing out there, I'm seeing a lot of cookie cutter portfolios, and cookie cutter portfolios means you go to a big company and they're going to put you all in their own funds. So you can't tell me that company is the best at mid cap, the best at small cap, the best at large cap, the best at growth, the best at value. So, what we do, Gary, in terms of managing the money, we are looking for the best of the best. We want an all-star team of exchange-traded funds and managers in our portfolio. Period. End of story. We don't care what the company is, as long as it's a good company. But it's also building relationships with the managers, Gary. I have personal relationships with most of the managers. If it's not the manager, it's somebody very high up in the company that we work with, that we can call and talk and chat with. One example is the Capitol Hill Energy Fund. Now, I met the guy who designed the fund. He came to my office. I sat with him for an hour and a half, and I was able to question him. John Davi at Astoria, I can call them up and get them on the phone. If you look at Market Desk Momentum, FMTM is a symbol. I can get John Clements on the phone.
That's impressive.
So you don't have that advantage when you're at a big firm unless you're managing $10 billion.
That's a great point.
At least that's my opinion.
860-657-8380. I want you to call that number right now for the very reasons that Mark just mentioned. You're not going to get that any other.
Well, I mean, you might, but it's hard to find.
You can look them up online at www.frplan.com or stop by his office, Financial Resources Group. They're in Glastonbury. Schedule an appointment first, though, and ask about that. We talked about the top of the show, the $2,500 value. What an impressive checklist that is. In fact, it's probably worth more than $2,500. Again, 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.